Hi, I'm James Robinson, and this is my stock pick of the week. Today we're going to be talking about dividends for the company Paccar, symbol PCAR. So first thing we look at obviously with dividends is the actual dividend chart, see how dividends have been paid over time. Looking at the dividends per share, it looks like dividends, with the exception of a couple years during the recession, have managed to go up pretty much every year. They've gone up more dramatically the last few years. One big drop in 2008 and 9, but again, that was obviously to be expected. That was the middle of that giant recession. We also look at total dividends paid in terms of the amount of cash paid out every year. That gyrates a little bit, but again, the company's paid dividends. I understand the company's paid dividends every year for 81 years, and with the exception of 2 years, those dividends have gone up every year. So very solid dividend payer, nice dividend increases at a rate greater than inflation. But of course, when we're looking at dividends, I think you should look at more than just how much is paid and how steadily it's paid. You should try and figure out how safe it is. So we look at dividends for the obvious yield and growth, but I also look at dividend safety in the context of earnings, dividend safety in the context of cash flow, and generally speaking, dividend safety in the context of debt load, which is really dividend safety in the context of interest paid. In this case, obviously, Paccar has got a net interest income, not interest paid, because they're borrowing money, which they then loan out at a higher interest rate, so they get a arbitrage on that. So long story short, we're going to skip the dividend safety in the context of current debt load and just go on with the other three. So here you can see dividend safety. The first thing we look at is yield and growth. The yield for the stock is about 1.72%, which is fractionally lower than the S&P average yield, which is about 1.73%. The dividend growth has averaged 18.3% in the last 5 years. I actually don't expect that to continue. I think the company's dividends are actually a little bit high. I would not expect them to continue to increase it every year. I don't expect it to go down, but I don't expect to increase it quite that rate. I want to look at this chart and talk to you about it a little bit for you to understand what's going on, because it looks a little confusing. On the right-hand side of the chart is the percentage increase, and that's also measured by I don't know whether that's orange or red bars. You see that in 2016, it looked like it went down. What happened was there was a special dividend in 2015 of $2 a share. And so when it went back to the normal rate, it looks like the stock went down, but what happened was it went down relative to that special dividend in 2015. So effectively, if you look at the chart on the other side, which is the amount of dividends per share being paid, you can see that there was that big dividend in 2015, but then it was a lower dividend, but it wasn't negative. So about $1.65 in 2016, and then it's gone up since then. So the chart's a little bit misleading. So dividend safety in the context of earnings, what we'd like to figure out here is how much of the earnings is the company paying us in dividends. Obviously, if you saw a situation where the company's paying us more than 100% of their earnings in dividends, that's extraordinarily unsustainable. And if a company's not paying just a fraction, 15 or 20% of their earnings, it means, in my opinion, the management isn't doing a very good job of rewarding the owners for the company's profits. So here you can see the payout ratio was very large in 2015. That's when they did that big special bonus that we talked about. But in other cases, the green bar is the earnings that the company had for the year, and the red bar is the dividends paid that year. You can see that the current payout ratio is about 47.7%. That's fine. The S&P 500 is around 40%, so that's great. The average payout ratio for the last 5 years was 69.2%, but again, that includes that one big special payout. I would ignore that number a little bit. So the average payout ratio of the S&P 500 is about 40%. So long story short, the payout ratio as it relates to earnings is absolutely fine and not a problem, and is a reason to feel confident about the stock. So here you can see payout ratio as related to cash flow. So we're going to take the last year here. The company had about $2.8 billion in cash flow from operating activities. They had capital expenditures of $1.9 billion. That's money they had to invest back in the business. That left them free cash flow of $889 million. And they then paid $1.1 billion in dividends, which means they paid 128% of the free cash flow in dividends. That's not sustainable, right? That's a problem. I don't like to see dividends being paid in that high a proportion. If you go back to the last couple of years, you can see in 2017 and 2016, the ratio was in a more manageable number. They paid that giant bonus in 2015. Without getting into why, it was 5 years ago. I'm not sure I care much. But that number was 246%. And then in 2014, it was 81%. So 3 out of the last 5 years, it's been a pretty reasonable number. But a couple of years, it's been above average, and it's been above average enough that the average payout ratio over the last 5 years is also over 100%. So that's something that I would look at. This company I'm not buying this company because it's a dividend payer. I'm buying this company because I think it's undervalued. The dividend's sort of a bonus. If the company paid no dividend, I would probably still be interested in it. So it's not the end of the world for me to see this, but if I continue to see this, it would detract from my desire to have this company be a very long-term hold for me. So that's we're not going to talk about the dividend payout in relation to debt because it's kind of convoluted. The company has a net interest income as a result of the fact that they loan money out to people who are buying their trucks, and they've borrowed the money to do that. And so I'm not sure whether I want to say, well, what happens if they couldn't collect the money from their creditors, or it just becomes convoluted. So I've decided to ignore that analysis for this company. So that's really what's going on with the dividends for this company. Pretty solid dividend payer, not enough that you'd buy the stock just for the dividend. And while it's reasonably comfortable dividend, it's not solid enough again that it would be the kind of thing that make me buy it.